Hi, and welcome to Aaron and Heather's Blogcast, where we tell you what the media is saying about real estate.
And what they're not saying.
Heather, what are they saying about real estate today?
Well, we have an article from Keeping Current Matters, one of our favorite producers of articles.
Content, yeah, they're great.
Content. Talking about mortgage rates and what the top indicator is for those rates and where they're heading.
Hot topic right now.
Yes.
We've been seeing them creep up over the last couple of weeks.
Yeah, with what, like 6 buyers for every home on the market. I think people care what that purchasing power is going to look like for them.
Kind of important. So what are they saying in there?
So they're saying that mortgage rates have increased significantly since the beginning of the year. We were at about 3.22%, and we're about 3.55%. It's only not even mid-January, February. Where are we? What month is this?
Mid-February, yes.
Got it.
They have been going up since mid-January, so you got that right. That's perfect.
Thank you.
Yeah.
Oh, I don't even know what's happening in my life right now. And there's a correlation, right, between the 10-year treasury yield and interest rates. So as that changes, mortgage rates change.
Right.
And they're saying that should continue to change and go up. As of last week, the treasury yield was 1.81%, which is about 1.74% below the mortgage rate of 3.55. So there's a slight spread between the two, but we're going to continue to see that rise. And within the next 3 years, which really this isn't a horrible statistic, which I was glad to see, mortgage rates will be around 4.5%.
Okay.
But that's less than 1% above where we're at right now. And I think at our lowest, we were seeing 2 3/4. I think when I refied.
So they're talking about a 30-year fixed rate, kind of standard financing that any home buyer would want. Okay, great. Yep. Great.
But what they're not saying, if I can continue,
sure,
is that 4.5% over the next 3 years, that's not 4.5% above where we're at now. Right. That's where we're going to be at in the next 3 years, is still extremely low. I remember when my parents bought their last house, I was in like 6th grade. Rates were in the 9s, 10s, somewhere around that. So it's still extremely affordable, but we are so hyper-focused on what rates are because they've been extremely low. I mean, money's basically free.
Yeah. Yeah, just keep in mind that's, obviously it's been artificially lowered over that quantitative easing for the last, it feels like a decade now, right? So normally something like interest rates would be tied to the economy, and the free market of America would be making that adjustment naturally by consumer price index, by treasury bonds and yields. But what we're seeing here is Fannie Mae, which is a government-backed entity, buying all the mortgage-backed securities so that our market and our economy as a whole can continue to be stimulated. Yeah. And you can't do that from an arbitrary standpoint for a long period of time without thinking it's going to have an impact on the economy.
Right.
Absolutely. So we're seeing that on inflation right now, and we're going to see interest rates increasing. People panic and think that's a negative thing. But if you think about it from an economic standpoint, it's a really good sign. Yeah. It shows we have a healthy economy. Yep. Right? There's confidence in our ability to create wealth as a country at that point if our interest rates are increasing. So when you hear that the Fed is meeting and they use terms like we're going to keep the interest rates low for the foreseeable future, which is what they've been saying for a long time, that's code for we're not going to make any major adjustments. But this last meeting a couple weeks ago, when they said that we plan on increasing interest rates on a consistent basis, that's a big difference. Right. So some are talking about 7 increases over the next year. Some are talking about 5. These are obviously not directly tied to the 30-year fixed rate, but they are the short-term rate, and so that does impact us. But all of this kind of comes into the same conversation about interest rates.
Well, and what it means for our listeners is that if you are a buyer and you're ready to move now, do it. right? Before there's 7 increases. However, long term, just know that if you're not ready for the next year or two, that it's not a major deal breaker. It shouldn't be. Affordability is still there. And as those rates rise, even just a little bit, it should settle the market as far as sale prices go just a little bit. So we're hoping that it just creates more of a balance between the two, because right now we're extremely out of balance, as we're seeing in every deal that we do, buyer or seller. And that it's not necessarily a bad thing. We need balance in our economy.
Absolutely. And we'll link this article in this blogcast so you can research it, because one thing that's very fascinating is it does give you a chart that shows you that affordability that Heather is referring to here. Is if you're not exactly sure how 0.5% on an increase of the interest rate affects your monthly payment, which, let's be honest, that's all that matters to us. If we're obtaining a home with a loan, not paying cash for it, that's what really matters to us, is what's our monthly payment look like. And you actually will be surprised that the higher the purchase price, but the lower the interest rate, is actually easier on your monthly payment. Yeah. So as these interest rates go up, even if they're 0.25% or 0.5% or 0.75%, it does impact your purchasing power pretty aggressively. So we want to make sure that you have the information. That's the reason we take the time to do these blogcasts, and we hope this is helpful for you. Thank you so much for listening. Tune in next time, and we'll see you then.